Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate jargon. And today we've got a real page turner from Veeva Systems Incorporated, a company that's all about cloud solutions for the life sciences industry. So buckle up because we're about to decode their latest report and see what's really going on behind the numbers. And if you appreciate getting honest insights from these filings, make sure you're subscribed. We also have a Discord community linked in the description below, so join us there for more discussions. Alright, so this is Veeva Systems Incorporated's quarterly report on Form 10Q for the period ending the 31st of October 2025. Think of this as their progress report card for the last 3 months and also a look at the first 9 months of their fiscal year. What's really interesting here is how Veeva is positioning itself in a rapidly changing industry, and are they hitting their marks or are there storm clouds on the horizon? Let's dive straight into the financial heart of the matter, the condensed consolidated balance sheets. This table gives us a snapshot of what Veeva owns and what it owes on. 2 different dates, the 31st of October 2025 and the 31st of January 2025. First up, look at their cash and cash equivalents. On the 31st of October 2025, they had a cool $1.66 billion. That's a huge jump from their cash position a few months earlier in January 2025. This means they've got plenty of money readily available, which is always a good sign. Now let's look at their short-term investments, an area where they really shine. On the 31st of October 2025, Veeva had over $4.97 billion in short-term investments. That is a pretty staggering amount and a substantial increase from the 20th of January 25's $4.03 billion. This shows they are not only generating a lot of cash, but are also investing it wisely to earn returns. Here is something crucial for a software company: deferred revenue. On the 31st of October 2025, they had $822 million in deferred revenue compared to a much larger $1.27 billion in January 2025. This means money received for services not yet delivered has gone down. While this can fluctuate, it's worth keeping an eye on, as it can indicate future revenue. Now for goodwill, $439 million both in October and January. Goodwill represents the value of an acquired company above its fair market value. It's a common accounting practice, but a large amount of goodwill can sometimes signal past expensive acquisitions. Veeva's is consistent here, just showing the value of what they've bought. Adding it all up, their total assets on the 31st of October 2025 were over $8 billion. That's a solid increase from $7.3 billion in January. On the other side of the balance sheet, their total liabilities are about $1.05 billion in October, down from $1.5 billion in January. This is generally a positive trend, showing they owe less and own more. Let's check out their stockholders' equity, specifically the additional paid in capital. It sits at about $2.9 billion in October, up from $2.3 billion in January. This increase often comes from issuing new stock or from exercising stock options. And then there are retained earnings, which represent the profits the company has kept over time. On the 31st of October 2025, they had a massive $4.1 billion in retained earnings, a healthy increase from $3.4 billion in January. This is pure firepower built up over years. Next, let's look at the company's performance over time. The condensed consolidated statements of comprehensive income. This tells us how much money they made and how much it cost them. Their subscription services revenue is the star of the show. For the 3 months ending the 31st of October 2025, it was $682 million, a nice jump from $580 million in the same period last year. And for the 9 months, it reached a whopping $1.97 billion, up from $1.67 billion. This shows their core business is growing strong. Professional services and other revenue also saw growth from $118 million to $128 million for the quarter, and $349 million to $382 million for the 9 months. While not as big as subscriptions, it's still a positive trend. So total revenues for the 3 months hit $811 million, up from $699 million last year. For the 9 months, total revenues were $2.35 billion, a solid increase from $2.02 billion. With that revenue increase, their gross profit, which is revenue minus the direct costs of producing that revenue, also grew significantly from $524 million to $611 million for the quarter, and from $1.5 billion to $1.79 billion for the 9 months. That's a healthy margin. Now let's talk about what it costs to run the business operational expenses. Research and development expenses went up from $172 million to $191 million for the quarter, and from $511 million to $568 million for the 9 months. This indicates they are investing in future products and services, keeping them competitive. Sales and marketing also saw an increase from $98 million to $110 million quarterly, and from $297 million to $318 million for the 9 months. This suggests they are pushing to acquire new customers and expand their market reach. All this growth in revenue and careful management of expenses led to increased operating income. For the quarter, it jumped from $181 million to $240 million, and for the 9 months from $503 million to $670 million. That means the core business is becoming more profitable. Other income net was $71 million for the quarter, up from $60 million, and $206 million for the 9 months, up from $171 million. This includes things like interest income from their investments and currency exchange gains or losses. It's a nice boost to their bottom line. And the big number, the net income. For the 3 months ending the 31st of October 2025, their net income was $236 million, a significant rise from $185 million last year. For the 9 months, it was $664 million, up from $518 million. Veeva is clearly making more money. Their comprehensive income, which includes unrealized gains or losses on investments, also shows solid performance with a gain of $248 million for the quarter and $683 million for the 9 months. This shows their investment portfolio is also doing well. Now let's look at the statements of stockholders' equity, which details changes in the ownership structure. The amount of common stock itself remains at a nominal $2, reflecting its par value. The additional paid-in capital shows a healthy increase from $2.38 billion in January to $2.91 billion in October. This often comes from employees exercising their stock options and companies issuing new shares. And again, retained earnings show a strong upward trend from $3.45 billion to $4.11 billion. This signifies that a significant portion of their profits is being reinvested back into the company rather than being distributed to shareholders. Let's check out earnings per S-Share. Basic earnings per S-Share went from $1.15 to $1.44 for the quarter, and their 9-month EPS rose from $3.21 to $4.06. This is positive for shareholders, indicating increased values per S-Share. And diluted EPS, which accounts for potential new shares, also increased from $1.13 to $1.4 quarterly and $3.15 to $3.96 for the 9 months. This shows good earnings growth even when considering all potential shares. Here's the statement of cash flows. It tracks the actual cash coming in and going out. This is crucial because profit on paper doesn't always mean cold, hard cash. Net cash provided by operating activities for the 9 months was $1.3 billion, a healthy increase from $1.02 billion in the prior period. This confirms their business operations are generating strong cash. Investing activities show a significant outflow of $936 million for the 9 months, down from $684 million in the prior year. This is largely due to their substantial investments in short-term securities, which we saw earlier. $2.38 billion was spent on purchases, and $1.47 billion was realized from maturities and sales. They are actively managing a large investment portfolio. Financing activities provided about $168 million in cash for the 9 months, up from $5 million. This increase is mainly from proceeds from stock option exercises. And at the end of the day, their total cash and cash equivalents stood at over $1.66 billion. That's a substantial chunk of available funds, more than enough to cover short-term needs. Now turning to the notes to the financial statements. The first note provides a summary of Veeva's business and accounting policies. They really highlight their position as a leader in industry cloud solutions for the life sciences sector, targeting R&D and commercialization. It also mentions their fiscal year end is the 31st of January, which is important context for all these dates. This section discusses new accounting rules that are on the horizon. It seems Veeva is staying ahead of the curve, ready to implement new disclosure requirements for income taxes and other areas. This is good housekeeping and shows they are prepared for future regulatory changes. Back to their investments, the short-term investments note gives us a closer look at the quality and composition of their $4.97 billion portfolio. As of the 31st of October 2025, a significant portion is in corporate notes and bonds, around $2.89 billion, and US Treasury securities at $1.26 billion. They are well diversified and appear to be in relatively safe investments. There are some small unrealized losses on investments, but given the scale, these are minor and typical for such a portfolio. For goodwill, Veeva reports $440 million. This suggests they have made acquisitions in the past. Intangible assets are listed with customer relationships being the largest component, worth about $31 million after amortization. This is a normal part of a growing tech company's balance sheet. The fair value measurements note breaks down how they value their assets and liabilities. Most of their financial assets are in level 2 categories, meaning they are valued using observable market data, not just quoted prices for identical assets. This is a standard practice for their type of investment portfolio. Their effective tax rate for the 9 months ended the 31st of October 2025 was 24.2% compared to 23.1% the prior year. They mentioned the impact of new tax legislation, the One Big Beautiful Bill Act, which sounds like a mouthful, but essentially changed how they calculate taxes and benefits. This note explains deferred revenue and what's called performance obligations. While deferred revenue decreased from January to October, the amount of transaction price allocated to future revenue from existing contracts for subscriptions is not significant and mostly expected to be recognized in the next 12 months. This means future revenue from current contracts is pretty predictable. For leases, they have operating leases for their offices, and the expense for these leases is relatively stable at $4 million quarterly and $13 million for the 9 months. Their lease liabilities are manageable with the bulk of payments due in the coming years. Here we see more details on stock options and restricted stock units. The number of outstanding shares increased slightly, which is common with stock-based compensation. The intrinsic value of their outstanding stock options is substantial, over $1.6 billion, which is a big incentive for employees. The net income per S-Hair calculations are straightforward. Both basic and diluted EPs have seen solid increases mirroring their profit growth. Basic EPs for the 9 months is $4.06, up from $3.21 previously. This note discusses legal proceedings. Importantly, it states that Veeva and IQVIA settled all ongoing litigations in August 2025. This is great news as it removes a major uncertainty for the company. They also state they are not involved in any other legal proceedings that would materially impact them. Veeva explicitly states they operate as a single reportable segment. Their CEO reviews financial information on a consolidated basis. This means their business is highly integrated and they don't break down performance by individual product lines externally. They do, however, provide an adjusted operating income which excludes stock-based compensation, amortization of purchased intangibles, and litigation charges to give a clearer picture of their operational performance apart from these specific non-cash or one-off items. This section shows their revenue breakdown by geography. North America is their biggest market at around 60% of revenues, with Europe following at 28%. They also break down revenue by product, commercial solutions, and R&D solutions. Subscription services are split almost evenly between the two areas, with R&D solutions revenue expected to grow. Now we move to management's discussion and analysis, or MDWEA. This is where the company explains the numbers in more detail. They re-emphasize their leadership in the life sciences cloud solutions market with their 4 main product categories: development cloud, quality cloud, commercial cloud, and data cloud. They note that R&D solutions are expected to capture a larger percentage of revenue in the future. The tables here basically re-show the income statement data, but with percentage changes. We've already walked through the revenue and profit growth, so this just confirms it. The cost of revenues increased, but importantly, their total gross margin percentage remains strong, at 75% for the quarter and 76% for the 9 months ending October 2025. This means they are keeping a large portion of their revenue as gross profit. R&D and sales and marketing expenses are up as expected as the company invests in growth. General and administrative expenses actually decrease slightly quarter over quarter, which can be a good sign of efficiency. This is a critical section. Veeva provides non-GAAP measures like adjusted operating income and non-GAAP net income. They explain they exclude items like stock-based compensation, amortization of purchased intangibles, excess tax benefits, and litigation settlement charges. They argue these provide a more consistent view of their ongoing operations. It is always important to look at these alongside the GAAP numbers to understand the full picture. Their liquidity is strong. They have over $6.6 billion in cash and short-term investments. They believe this is enough to cover their needs for at least the next 12 months. They are primarily using cash generated from operations to fund their business. The One Big Beautiful Bill Act is mentioned again as it is expected to increase their operating cash flows through R&D deductions. The risk factors section is quite extensive, and this is where companies lay out all the potential bad things that could happen. Veeva highlights risks around data security, competition, product defects, customer migration challenges, and reliance on key customers. They also point out risks unique to the life sciences industry like regulatory changes and industry consolidation. A significant portion also details the challenges and potential liabilities associated with AI and data privacy regulations. They also acknowledge the volatility of their stock price and the potential impact of macroeconomic and geopolitical factors. The risk factors are quite detailed. One key point is their reliance on third-party providers like Amazon Web Services and Salesforce for their cloud infrastructure. Any disruption from these providers could significantly impact Veeva. They also mention the ongoing migration of their customers from their legacy Veeva CRM application to their newer Vault CRM solutions, a complex process that carries inherent risks. The concentration of revenue within a few key customers is a notable risk. While this is common for B2B software companies, it means the loss of even one major client could have a substantial impact. Competition is fierce as expected. They list giants like Salesforce and IQVIA as key competitors, and note that new technologies and evolving AI capabilities could change the competitive landscape. Their heavy reliance on the life sciences industry is a double-edged sword. While it allows them to specialize, it also means they are highly susceptible to changes within that specific sector, including drug pricing regulations and healthcare policy shifts. This is a really interesting point. Veeva is a public benefit corporation PBC. This means their board has to balance the interests of shareholders with other stakeholders like customers, employees, and communities. This can lead to decisions that might not maximize short-term shareholder profit, but are seen as better for the long-term health of the company and its mission. The legal implications of this are still evolving and could present challenges. Finally, we have the exhibits. This is where all the supporting legal documents and certifications are listed. We will not be diving into these today. We are focusing on the financial story. So what's the story here with Veeva Systems Incorporated? Financially, they are doing remarkably well. Their revenues are steadily climbing, driven by their core subscription services business. They've got a mountain of cash and investments showcasing strong operational performance and wise treasury management. Their profitability is increasing and they've successfully navigated the settlement of significant legal disputes, which removes major overhang. The risks are standard for a growing tech company in a regulated industry. They need to keep innovating, secure their platform, and manage their customer relationships carefully. The concentration of revenue is a point to watch, as is their dependence on cloud infrastructure providers. The public benefit corporation status is an interesting social experiment in corporate governance, and while it might attract certain investors and employees, it could also create unique legal and strategic challenges if not managed perfectly. Overall, Veeva looks like a solid company with a clear strategy and strong execution. They are growing in a key industry and seem to be managing their finances and risks effectively. Their investment in R&D and sales and marketing suggests they are preparing for continued future growth. Alright, that's our deep dive into Veeva Systems' latest filing. What do you think about their financial health and their unique approach as a public benefit corporation? Let us know your thoughts in the comments below. If you found this breakdown valuable, please hit that like button, it really helps us out. Subscribe for more decoding of corporate filings, and don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching. See you next time.